Rich Dad used to say something that sounds almost too simple to be profound. He said, "It's not how much money you make, it's how much money you keep." Most of us hear that and think, sure, obviously. Don't spend more than you earn. We've heard that before. Save your money. Be responsible. But that wasn't what he meant. He wasn't talking about frugality. He wasn't talking about budgeting apps or cutting out coffee. He was pointing at something much more fundamental: a literacy, a basic understanding of how money actually behaves. And he believed, strongly, almost urgently, that without this literacy, it almost doesn't matter how hard you work or how much you earn. The money will find a way out. Let's start with a story that plays out in a version of itself almost every single day, somewhere in the world. A young professional lands their first real job. Good salary, real achievement, genuinely earned. They celebrate. And then, gradually, their life expands to match the income. A better apartment. A new car. They can afford the payments now. Nice dinners, a gym membership. The things that feel like markers of having made it. A few years pass. They get a raise. The apartment gets bigger. The car gets nicer. Maybe a house enters the picture. A big one because they can qualify for the mortgage. And through all of this, they feel financially responsible. They're not gambling. They're not making crazy decisions. They're doing what people do. But here's the thing Kiyosaki wants us to see. A decade in, this person still needs their job as desperately as they did on day one. Maybe more so, because now the expenses are larger. The mortgage requires the salary. The car payment requires the salary. Everything requires the salary. The income went up. The expenses went up. The financial security didn't change at all. This is what happens without financial literacy. So let's talk about the concept at the heart of Lesson 2. The one that Rich Dad said was the most important financial concept a person could ever learn. The difference between an asset and a liability. Rich Dad's definitions were radically simple, almost frustratingly so. But that simplicity is the point. An asset puts money into your pocket. A liability takes money out of your pocket. That's it. That's the whole definition. Now, this might seem obvious, but here's where it gets interesting, and where most people's financial education breaks down completely. Most of us have been told, our whole lives, that certain things are assets. A house is an asset. A car is an asset. Your salary is your financial foundation. Rich Dad would gently, firmly disagree. Let's take the house, the sacred, universally celebrated thing that everyone is supposed to work toward owning. Rich Dad asked, "Does your house put money into your pocket or take it out?" Think about what owning a home actually involves. You have a mortgage. That's money flowing out every month. Property taxes, money flowing out. Maintenance, repairs, insurance, money flowing out. If the roof needs replacing, or the boiler breaks, or the neighborhood changes, money flowing out. Now, yes, your home may appreciate in value over time. And yes, if you sell it eventually, you might make a profit. But while you're living in it, it is consistently, reliably taking money from you. It requires income to maintain it. It does not generate income. By Rich Dad's definition, your home, for as long as you're living in it, is a liability. This is the part where people get a bit defensive, maybe even offended. Because owning a home is a dream for many people. It feels like security. It is security in certain ways. But Rich Dad wasn't saying don't buy a house. He was saying, call it what it is. Know what column it lives in. Don't confuse a liability for an asset and then wonder why, even as your net worth on paper grows, you feel financially tight. Same question for a car. Does your car put money into your pocket? Generally, no. It loses value the moment you drive it. It costs insurance, maintenance, fuel, registration. It takes money out. It's a liability. Now, you may need a car. That's fine. Rich Dad wasn't saying eliminate all liabilities. He was saying, know the difference. Stop calling things assets when they're actually draining your financial resources. Because here is the critical implication. If you spend your whole income-earning life accumulating liabilities that feel like assets, a bigger house, a newer car, more things, you will end up with a life that looks wealthy from the outside and is financially fragile on the inside. The wealthy, Rich Dad observed, do something different. They spend their energy acquiring actual assets, things that generate income, rental properties, stocks that pay dividends, businesses, royalties. They build what Kiyosaki calls the asset column, and they let it grow, and let it generate income that covers their expenses. Over time, when their asset column produces enough income to cover all their liabilities, they are, by definition, financially free. They don't need a job. They might choose one, but they don't need one. That's the goal. Not a certain salary, not a certain net worth figure. The goal is income-generating assets that outpace your expenses. Here's the visual that Kiyosaki uses in the book, and it's worth really sitting with. A wealthy person's cash flow looks like this. Income flows from assets, which cover expenses. The salary, if there is one, goes primarily toward acquiring more assets. A middle-class person's cash flow looks like this. Income flows from a job, goes directly to expenses, including liabilities that masquerade as assets. The cycle repeats. The asset column never grows. Two flows, two completely different financial futures. And the difference is almost invisible on the surface, because the middle-class person might be earning more than the wealthy one, at least in the beginning. Literacy. That's all it is. The ability to read these flows, understand which column things go in, and make conscious choices based on that understanding. Now, Kiyosaki was also making a broader argument with this lesson, one that was directed partly at the school system. He believed, and this is still relevant, that we send children through years of formal education and teach them almost nothing about how money works. Not because money isn't important, obviously it's important, but because the people designing education were often poor dad types, academics, government employees, professionals who valued job security and credentials over financial independence. And so we graduate generations of people who can read literature and solve quadratic equations, but cannot read a balance sheet, cannot tell an asset from a liability, cannot understand why their financially comfortable salary somehow never feels like enough. Financial literacy isn't complicated. It can be learned, but it has to be sought, because nobody is going to hand it to you. One concrete thing before we move on. This week, just as an experiment, write 2 columns. Label 1 assets and 1 liabilities. Now list everything in your financial life in one column or the other, using Rich Dad's definitions. Does it put money in your pocket? Asset. Does it take money out of your pocket? Liability. Be honest. Your car, your house or rent, your savings account, any investments, any subscriptions? You might find that the asset column is nearly empty. That's not a judgment, it's information. It's where most people start. The point is simply to see it clearly, maybe for the first time, because you can't change what you can't see. In Lesson 3, we're going to talk about one of the most misunderstood pieces of advice in the book. Mind your own business. Spoiler, it's not about entrepreneurship. It's about something more specific and possibly more powerful. Something that applies to you whether you ever start a company or not. I'll see you there.